This is Germany. It was once regarded as one of the biggest industrial powers in the world, known for its premium cars such as Mercedes and BMW, and for being the European Union's powerhouse. But Germany's struggling. It is in the middle of an economic downturn that has exposed long-term structural issues with its economy. Strong growth in previous decades was built on the back of importing cheap Russian gas to power Germany's highly competitive export industries. But with this cheap gas gone, the German manufacturing model doesn't work anymore. The German economy shrank by 0.3% in 2023, the only G7 economy to do so. And its forecast for economic growth for 2024 has been revised down from 1.3% to 0.2%. This means that Europe's largest economy has effectively stalled. In fact, a potent mix of short-term geopolitical challenges and deeper structural problems, along with a divided and seemingly ineffectual government, have prompted economists to call Germany the sick man of Europe. In this video, we will explain to you exactly what is wrong with Germany and what the consequences may be. So, give this video a thumbs up and let's get started. The German economy was not always like this. Rapid industrialization in the late 19th and early 20th centuries made the nation a leader in industries like chemicals, electrical engineering, and automotive manufacturing, with giants like Siemens and Mercedes-Benz spearheading the charge. Having invested heavily in education and vocational training, Germany was renowned for its highly skilled and efficient workforce. As a founding member of the EU, it benefited from broader market access and political stability, further boosting its economic growth. In the 1990s, Germany implemented significant labor reforms to deregulate its labor market, reduce unemployment, and increase labor market flexibility. These reforms led to a more dynamic labor market, contributing to economic growth and reducing unemployment rates. And by focusing on manufacturing high-quality goods for export, Germany became a global export leader. Surging demand in China and developing markets for German manufactured goods helped to create millions of jobs and drove strong economic growth in Germany for more than 2 decades. However, the war in Ukraine changed everything. Germany was heavily reliant on Russian gas, particularly its industrial sector, but when it began to disappear from the pipelines, the German economy was faced with a serious problem. Energy costs soared, sparking inflation to shoot up, peaking at 6.9% in 2022. When inflation surged, consumers cut back on purchases. The European Central Bank responded by raising interest rates to 3.75% to help curb rising prices. But the higher costs of borrowing have depressed housing construction and other interest-sensitive sectors, and inflation has stuck around, proving to be much stickier than many thought, with a rate of 5.9% in 2023, meaning interest rates have remained high, sitting at 4.25% at the time of the making of this video. It should be noted that Germany has since done a good job of replacing Russian gas, although it remains vulnerable to future supply shocks. Before we assess the longer-term issues with Germany's economy, please take a moment to help us out by hitting that subscribe button. It only takes 2 seconds, and each new subscriber is a massive help for the channel. Okay, moving on. A post-pandemic rebalancing of global demand away from manufactured goods and back towards services has also been unfavorable for Germany's manufacturing-intensive economy. China was Germany's second biggest export market as recently as 2021, with Germany's luxury car brands being particularly attractive to its young and increasingly affluent population. But China is facing its own economic challenges, including slowing growth and record youth unemployment, reducing its demand for German goods. In fact, China has now become a competitor to Germany. Thanks to the rise of the electric vehicle, Chinese car exports have been soaring in recent years. The export of cars from China increased from around 1 million in 2021 to 5 million in 2023. In fact, China shipped more cars abroad than Germany in 2022, becoming the second biggest exporter and being close to overtaking Japan as the world's largest car exporter. And a large proportion of these cars have been exported to European markets. Chinese automobile companies have 2 major advantages over their German rivals. The switch to electric vehicles is allowing for technological disruption in the car industry, and the years of Germany's world-leading expertise in combustion engines now stands for less than it once did. China is the world's largest automotive market, and this allows Chinese brands to scale up production and reduce costs quickly, resulting in very competitive pricing in what is otherwise a still very expensive electric vehicle segment. China's rapid transition to electric vehicles has eroded market share from international auto giants who have been slower to release new models in the category. New energy vehicle penetration in China reached 40% of new passenger car sales in 2023, with sales in Germany's Volkswagen cars being among the most impacted by this transition. This spells bad news for the German automotive industry that is not only losing customers in China, but is also facing increased competition, tighter pricing, and lower sales as Chinese cars continue to become more popular. German companies are also struggling to find talent as the nation is facing a huge shortage of qualified professionals. This has been caused, in part, by Germany's aging population. Germany currently has 16 million people, or approximately 20% of its population, at retirement age, and this is expected to rise by another 4 million by the mid-2030s. This means a future of relatively more retired people and fewer workers, a combination that threatens economic growth and public finances. In fact, the share of working-age 15 to 64-year-olds has already fallen from 69% to 64.2% in the decade up to 2021. This decline is not expected to let up, with the growth rate of Germany's labour force projected to fall by 0.7% over the next 5 years, more than in any other G7 country. The ageing population will put downward pressure on GDP per person because there will be fewer workers for each retiree. It will also lead to a combination of higher social security contributions and increased demand for healthcare services, drawing workers away from other industries. In fact, spending on the welfare state, which includes state pensions and healthcare, accounts for 33.6% of Germany's GDP. Something which is likely to only rise in the future, and Germany is due to feel the pressure more acutely in the coming years because of its ongoing difficulties with labour shortages. Despite being a very rich country with many jobs, highly skilled international workers often don't see Germany as an attractive place to work, with its language and unnecessary red tape acting as high barriers to entry. In fact, Germany ranks 15th among the 38 OECD countries for attracting talent, lagging behind the likes of Australia, the UK and US. Shortages of highly skilled labour has increased the wages German companies must pay to attract talent, and has deterred investment. Germany's famed bureaucracy is hardly helping things. Building permits, operating licenses and company registrations all take far longer to process than the EU average. Digitization also lags behind much of the rest of Europe, and a 2023 Digital Competence Index placed Germany just 22nd in the world for it. Germans still rely heavily on cash, paying for nearly 60% of their goods and services with cash. Compare this to Norway, with only 2% of transactions being made with cash. Meanwhile, fast broadband connectivity in Germany, while slowly improving, is still patchy. All of this has a structural impact on productivity. Germany's productivity growth has ground to a halt, particularly in its services sector. Its productivity growth has slowed to 0.8% a year since 2008, but in recent years, since 2018, a productivity gap has emerged. In that time, Germany has started to lag behind the US, whose productivity has grown by 1.5% a year, compared to just 0.4% in Germany. Real output per employed person has also dropped in Germany, below both the US and other EU nations. This has been driven by slower productivity growth and a sharp decline in hours worked in Germany, particularly since the pandemic. Productivity is incredibly important for a country to achieve economic growth, allowing it to increase their economic output without increasing their labour force or their stock of capital. It should be noted that the nation's manufacturing sector remains an exception to the rule, but Germany's overall poor productivity is creating an environment where it's hard to develop new business, meaning less investment and less growth. Germany's faltering productivity levels need significant investment, But public investment in Germany is lower than in most advanced economies. And it is not helped by Chancellor Olaf Scholz's three-way governing coalition, which has been criticised as being excessively slow and unnecessarily cautious, irritating voters and creating a lot of economic uncertainty. Scholz's government needs to do something about Germany's struggles, but it is hamstrung by the nation's strict fiscal rules, developed by Angela Merkel's government in 2009, which established excessively strict borrowing and spending limits to prevent government debt payments from becoming unaffordable. Scholz's coalition aimed to circumvent these borrowing and spending rules by raising government money through special funds outside the main budget. But a recent ruling by Germany's highest court has prevented the government from investing 60 billion euros it had left over from its COVID-19 emergency fund. This money was intended to accelerate Germany's green energy transition and was to be invested in public infrastructure projects to improve and extend its railroads. But now the government will need to replace the 60 billion euros through tax rises or more debt, or cut its spending. This likely means the state won't be able to carry out many of its much-needed plans to combat its public infrastructure challenges, keeping the handbrake firmly on in the German economy. The impact has been damaging. For decades, the German government has underinvested in digitalization, education, health, trains, and climate action. This has meant daily services that people depend on have suffered, and underinvestment has led to the productive capacity of Germany being weakened. The things which make an economy stronger, education, health, mobility, and innovation, have all been neglected. Such deep-rooted structural issues cannot be solved easily, and Germany's economy is likely to remain a problem for at least the next few years. If you want to learn more about global economic affairs, head on over to this video where we cover just that. Thanks for watching, and see you next time.